Welcome back. Listen, if you're joining us today, you are exactly where you need to be to really master the intricacies of financial reporting. So for this explainer, I want you to just picture a scenario with me. You're sitting right in the high-stakes hot seat. You're interviewing for a highly coveted record-to-report or fixed asset accountant role at a massive multinational corporation. Think Accenture, Genpact, or one of the big four firms. The interview panel has been grilling you on your resume, your knowledge of the accounting cycle, your SAP experience, and hey, you've held your own. But then, the hiring manager leans forward, steeples their fingers, and throws a complex scenario-based technical question right at you. They look you dead in the eye and ask, "During our annual physical inventory count, we discovered several ghost assets. Tell me exactly how you would treat them." Now, if you hesitate here, or just rattle off some generic journal entry without really grasping the business context, you're going to lose the room. But hey, don't worry, because by the end of this explainer, you're going to have the exact expert-level, 3-step framework to answer this question and absolutely wow that panel.
Okay, let's dive right into this. To nail this answer, we first need to define the problem for them. Ghost assets are, well, pretty much exactly what they sound like: literal apparitions haunting your balance sheet. Basically, these are items officially recorded in the company's fixed asset register, your subledger, that are just no longer physically present, located, or in use by the business. Usually, they pop up during a regular physical inventory count. You know the drill. The team goes out onto the factory floor with their barcode scanners, they scan the equipment, and suddenly, bam, the data coming back from the field just does not match the asset records in the ERP system.
To really impress the panel, you can't just speak in theory. You've got to anchor your explanation in a real-world scenario. Tell them a story. Imagine your company is a massive manufacturer. Your SAP fixed asset register shows you own 250 incredibly expensive manufacturing machines spread across multiple production lines. But during that year-end physical count, the operations team can only verify 230 of them. You've got 20 missing machines, 20 ghost assets. And let's be clear, this is not some minor rounding error. This is a material discrepancy that is going to severely impact the balance sheet, your depreciation expenses, and definitely your audit readiness.
So, step 1, investigation and verification, finding the root cause of the discrepancy. Now, an amateur accountant might panic and immediately start drafting journal entries to just write these things off. But you're an expert candidate, so you tell the panel that your very first action is absolutely not making a journal entry. Before you even touch the general ledger, you have to find the root cause. A discrepancy of this magnitude means there's a fundamental breakdown somewhere in the company's asset tracking or disposal processes. You've got to put on your detective hat. And honestly, this brilliantly illustrates the difference between a simple bookkeeper and a true financial analyst. You walk the panel through your investigation. First, you consult operations and maintenance. You literally walk the factory floor with the foreman. Maybe you find out an older machine was so problematic it was stripped for parts and the frame was sold for local scrap years ago, but nobody bothered to tell finance. Second, you review purchasing and disposal records. Maybe a machine was traded in for a massive discount on a new model and the disposal entry was just totally overlooked. And finally, you check for simple misidentification. Sometimes, similar-looking machines literally just have the wrong asset tags slapped on them.
Moving right along to step 2, the formal disposal process: removing the missing assets from the books.
Once that intense investigation of yours is complete, you're probably going to find that a portion of those 20 ghost assets truly are just gone, scrapped, lost, or abandoned without authorization. So now we reach the technical climax of your answer. It's time to officially remove these missing assets from the company's books so the financial statements reflect reality. Let's look at how this builds chronologically, because sequence is everything in accounting. Step 1. Update depreciation. You have to calculate and record the depreciation expense right up to the estimated actual date that asset went missing or was scrapped. Step 2. Remove the asset balances. You clear the original cost from the fixed asset account, and you clear the total accumulated depreciation recorded to date. And step 3, because this is a ghost asset that basically vanished without generating an invoice, there are 0 sale proceeds, meaning the entire remaining net book value has to be recognized as a loss.
Now you really bring it home for the panel by walking them through the exact journal entry. To clear this out, you're going to debit the accumulated depreciation account for the total amount accumulated over that asset's life. Next, since we got absolutely 0 cash for these missing machines, the remaining net book value hits the income statement entirely as a loss. So, debit loss on disposal for that exact net book value amount.
Finally, to wipe the asset from your balance sheet completely, you credit the fixed assets account for the original acquisition cost. Oh, and if you're using a system like SAP, casually mention using the proper transaction code to execute this retirement just to ensure both the subledger and general ledger update simultaneously.
But wait a second. What about the rest of those 20 missing machines from our story? You briefly explained to the panel that your incredibly thorough investigation actually resolved those without needing a write-off. You discovered a few machines had been physically transferred to a completely different plant location years ago, but the intercompany transfer was just never processed in the ERP system. So you execute those transfers. As for the others, you found they were physically present all along but misidentified during the count, so you simply rectified those incorrect tags. This proves to the interviewer that you don't just blindly write things off, you actually recover value through pure diligence.
Which brings us to step 3, corrective actions and internal controls, preventing the recurrence of ghost assets. So the absolutely crucial point here is this. Fixing the past error is only half the job. An average accountant cleans up the mess. A senior MNC-level accountant makes sure that mess literally never happens again. You seamlessly transition your answer into the strategic business value of your actions. Explain to them that discovering ghost assets is really a symptom of a weak control environment and you know exactly how to cure it. Detail the strict internal controls you'd put in place. First, require formal, documented sign-offs from operations, IT, and finance before any physical asset is ever allowed to leave the premises. Second, mandate cross-departmental training so operations knows they must notify finance immediately about any trade-ins, location transfers, or scrappings. And lastly, enforce a strict monthly reconciliation of the fixed asset register to the general ledger. That's going to ensure any manual entries that might have been missed in the subledger are caught in real time every single month.
By structuring your answer exactly like this, starting with the investigation, executing the technical disposal entries flawlessly, and wrapping up with strategic internal controls, you are showing them you aren't just some number cruncher. You are a true problem solver who actively protects the company's assets. Proactively identifying and resolving such a substantial issue ultimately strengthens financial reporting and audit confidence. I want to leave you with a final thought to ponder today. When you really think about it, is a routine physical inventory count just about counting boxes and machines, or is it actually the ultimate stress test for a company's entire culture of communication and financial integrity? Thanks for tuning in, and I'll catch you in the next explainer.